Hello and welcome back to The Note. We are living in more interesting times once more, and that's a perfect juncture for a big event this week, which will be the farewell of Ben Bernanke as chairman of the Fed. This week we'll see his final ever FOMC meeting as chairman, and yet again it will confront him with somewhat of a dilemma. What is his final legacy going to be, and how is he going to deal with this latest bout of problems in the emerging markets? With me now to discuss this once more is the principal of Fulcrum Asset Management and FT blogger, Gavyn Davies. Gavyn, thanks for joining me once more. Let's start by looking at a many ways familiar chart. This is the Fed's balance sheet as a proportion of US GDP. Ben Bernanke takes over right there, and obviously some very interesting things have happened during his tenure. How is his successor going to be able to deal with this legacy he's leaving her, this enormous pile up on his balance sheet?
Well, he has actually sort of mapped out the exit to some extent upon leaving. So it's going to taper down to about 25% of GDP by the end of this year.
Okay, and the slant has just very, very slightly narrowed there at the very end.
You can hardly see it.
Yes.
But yes, it's going to taper now.
Right.
And then the issue for Ms Yellen is whether she tries to get it back down again. And I actually don't think in her first term she will. I think it'll be 25% in 4 years' time. And she'll focus away from this. They'll try to mop this up in terms of its effect on interest rates. And the real debate is whether or not she will raise short-term interest rates in the course of her first term. So I think we're shifting away from the balance sheet, which is Bernanke's legacy, back towards a more familiar territory, which is rates.
But the balance sheet with 25% of GDP will be a given for the next few years, and the issue is when we actually use the normal, the more conventional measure of interest rates.
Well, I think probably is the answer to that. If you look at Japan, they did actually get the balance sheet down temporarily in the middle part of the last decade, but then it went rapidly up again. And I think all the central banks, until the economies are really back to normal, are going to have trouble getting this back down again.
Okay, now for the time being the path seems to be fairly clear that we've been conditioned to expect that the purchases will be tapered off by 10 billion a time, which means that we should be expecting 65 billion for this month. Let's take a look at what's been going on in emerging markets. Many people complain that the Fed's policies have a lot to do with leading flows into emerging markets. When they're cutting, people pour into emerging markets and vice versa. How much is what we're seeing in the emerging markets at the moment going to affect the FOMC? Could it even lead them not to taper this month?
Well, I'd be very surprised. That the one thing the FOMC can agree on at the moment is that they should taper at $10 billion a month. I think almost everything else they don't agree on. And if they diverge from that path, then I think other disagreements are going to crop up. So my guess is that you would need a very big shock in the markets to persuade the FOMC to move from this 10 billion a month tapering path.
And what's happening in the Turkish lira and the South African rand so far doesn't count as a very big shock?
No, I mean, I think the Fed's view, rightly or wrongly, is that they did not contribute much to this massive outflow of funds to the emerging markets. Right. And that the emerging markets now have to deal with this themselves, should have dealt with it earlier and now have to deal with this themselves. So unless the emerging market shock starts to have an effect on the world economy and on the US economy itself, I think the Fed is going to largely try to ignore it in setting its tapering pace. Okay,
so we're now, unless we really do begin to talk about something akin to Mexico in '94 or the Tiger Nations of '97.
Yes.
This isn't going to be a factor for them.
I think not a major factor. I mean, financial shocks can impact the Fed. The Eurozone crisis clearly impacted the Fed. QE3 here then happened, and of course money flowed out into the emerging world. So these things are all linked together. But my view at the moment is that the economic and market effects on the developed world are not sufficient to cause the Fed to think again.
Okay, and in terms of the bond yields, we've seen this slightly strange phenomenon where bond yields have actually US bond yields have actually come right back down to where they were a few months ago after this latest bout of concern in EM. How much can they control longer bond yields? How much does that matter to them?
I think they do have a pretty good element of control over long-dated yields through what they can do at the front end. No longer through buying bonds, because I think they are stopping that process. But if they set the front end at 0 and they keep it there for another 2 years, there's only a certain amount of carry that the market will allow in the bond market. And I think one thing we've seen lately is actually the sort of consensus view that US yields are headed higher for the next 2 or 3 years may not be right, because the Fed is going to continue probably to keep rates at the front end at 0.
Okay, Gavin, thank you very much, as ever. So, there we are. Bernanke is leaving, but I think I agree with Gavin. He has set an extremely clear course. It's going to be very difficult from the Fed to deviate from that unless something truly critical happens elsewhere in the world economy. We certainly haven't got there yet.